Welcome to the channel where we expose the truth behind the silver market manipulation that mainstream media won't tell you about. Right now, there's an unprecedented crisis unfolding in the precious metals world that could change everything you thought you knew about silver investing. Deutsche Bank has been forced to deliver a staggering 3 million ounces of physical silver. JPM has swooped in to grab 80% of available supply, and American silver eagles have completely vanished from retail shelves. This isn't just another market fluctuation. This is what many are calling an actual bank war. And if you're holding silver or thinking about buying, you need to understand exactly what's happening right now before it's too late. Let's start with the bombshell that's shaking the entire precious metals industry. Deutsche Bank, one of the world's largest financial institutions, has been forced into a corner where they must physically deliver 3 million ounces of silver. Now, to put this into perspective, 3 million ounces isn't pocket change. We're talking about roughly 93,000 kilograms of physical metal that needs to move from vaults into the hands of contract holders who are standing for delivery. For years, critics have argued that banks have been playing a paper game with precious metals, selling contracts they couldn't back up with physical metal, essentially running a fractional reserve scheme in the commodities market. What we're witnessing now appears to be the moment when that house of cards starts trembling. The circumstances surrounding this forced delivery are extraordinary. Deutsche Bank didn't wake up one morning and decide to be generous with their silver reserves. They're being compelled to deliver because contract holders are demanding physical settlement rather than cash settlement. This is significant because in normal market conditions, the vast majority of futures contracts are settled in cash, with only a tiny percentage actually demanding the physical commodity. When you see a spike in physical delivery demands, it signals that sophisticated investors have lost faith in the paper market and want to hold the real thing. These aren't retail investors making emotional decisions. These are institutional players, possibly other banks or major funds, who understand that having a claim on silver is very different from actually holding silver in your possession. Now here's where the story gets even more interesting. JPM Chase, the American banking giant that has been at the center of silver market controversies for over a decade, has managed to acquire approximately 80% of the available silver in this scenario. Think about that for a moment. While Deutsche Bank is being forced to hemorrhage silver, JPM is positioned perfectly to scoop it up. This isn't coincidence, this is strategy. JPM has been accumulating physical silver for years, and they've done it quietly, methodically, and in massive quantities. Some analysts estimate that JPM may hold anywhere from 600 million to 1 billion ounces of physical silver in their vaults. That would represent nearly half of annual global silver production stored by a single institution. The dynamics between these two banking giants reveal something crucial about the silver market that most people don't understand. There's physical silver and there's paper silver, and the gap between these two markets is enormous. The paper market, where futures contracts trade on exchanges like the COMEX, involves contracts representing billions of ounces of silver. But here's the catch. The actual physical silver available to back those contracts is a fraction of what's been sold on paper. It's been estimated that the paper to physical ratio could be as high as 100 to 1 or even higher. What this means is that for every 100 ounces of silver sold as contracts, there might only be one physical ounce actually sitting in a vault somewhere. The system works perfectly fine as long as everyone plays along and settles in cash. But when people start demanding physical delivery, the entire mechanism breaks down. Deutsche Bank's predicament illustrates exactly this problem. When they sold those contracts, they likely expected cash settlement or that they could easily source the metal if needed. But now, they're scrambling to deliver actual physical silver, and in a tight market, that's becoming increasingly difficult and expensive. The premium for physical silver over the paper spot price has been widening, which means it costs significantly more to buy actual coins and bars than what the official price suggests. This divergence between paper and physical prices is one of the clearest signs of market stress. Meanwhile, let's talk about what's happening on the retail side, because this affects everyday investors directly. American silver eagles, the most popular silver bullion coin in the United States, have essentially disappeared from retail availability. Dealers across the country are reporting that they're completely sold out, with wait times extending weeks or even months for new inventory. The United States Mint has struggled to keep up with demand, and premiums on silver eagles have skyrocketed. Where you might have paid $3 or $4 over spot price a few years ago, premiums are now frequently $8 to $12 per ounce or higher. In some cases, people are paying 30 to 40% above the spot price just to get their hands on physical American silver eagles. This shortage isn't happening in isolation. It's connected to the same supply squeeze that's forcing Deutsche Bank's hand and filling JPM's vaults. The silver market is relatively small compared to other commodities. Total annual silver production is around 850 million ounces globally. Compare that to gold, where annual production is about 110 million ounces. But gold trades at roughly 80 times the price of silver. The silver market is actually tiny in dollar terms, which makes it vulnerable to supply disruptions and concentrated buying. When major players start hoarding physical metal, and when mints can't produce coins fast enough, and when industrial demand remains strong, you get exactly the kind of shortage we're seeing now. There's another layer to this story that's absolutely critical to understand. Silver isn't just a monetary metal or an investment vehicle. It's an indispensable industrial commodity used in solar panels, electronics, medical applications, water purification, and countless other technologies. Roughly 50% of silver demand comes from industrial uses, and that percentage has been growing. The green energy transition alone is massively silver intensive, with solar panels requiring significant amounts of silver for their photovoltaic cells. Every year, industrial users consume hundreds of millions of ounces of silver that's gone forever, unlike investment silver, which can be recycled back into the market. This creates a structural supply deficit where annual demand exceeds annual mine production, a deficit that has to be made up from above-ground stockpiles. So what does all of this mean for you as an investor or someone interested in precious metals? First, understand that what we're witnessing is a fundamental battle between paper claims and physical reality. The fractional reserve system that's been used in precious metals markets is showing cracks, and when these systems break, they can break suddenly and dramatically. Second, recognize that the big players like JPM aren't accumulating massive amounts of physical silver for fun. They understand something about the future supply and demand dynamics that justifies tying up enormous amounts of capital in a physical commodity. Third, the disappearance of retail products like Silver Eagles, combined with forced deliveries at the institutional level, suggests we're in a genuine supply crisis, not just a temporary shortage. The broader implications are significant. If Deutsche Bank is struggling to deliver 3 million ounces, what happens if more contract holders stand for delivery? What happens if other banks find themselves in similar situations? The COMEX has force majeure clauses that theoretically allow them to settle in cash if they can't deliver physical metal. But invoking such clauses would essentially admit that the paper market is divorced from physical reality. That would be catastrophic for confidence in the entire system. We might be approaching a moment where the true price of physical silver diverges permanently and dramatically from the paper price, creating a two-tier market where paper silver trades at one price and physical silver commands significant premiums. For those holding physical silver, this environment suggests patience and conviction. The fundamentals supporting higher silver prices remain intact. Investment demand is surging, and the gap between paper and physical markets is widening. For those looking to buy, understand that you're likely going to pay substantial premiums for physical metal, and availability will be sporadic. The days of buying Silver Eagles at modest premiums appear to be over for the foreseeable future. Some investors are diversifying into other forms of physical silver like bars or rounds, which carry lower premiums than government-issued coins, though even these are seeing elevated premiums. The silver market has always been prone to volatility and controversy, but what's happening right now feels different in scale and significance. When major banks are forced to deliver physical metal, they apparently don't have readily available. When the world's largest banks are positioning themselves to control the majority of available supply, and when retail products disappear from the market entirely, these aren't normal market conditions. These are the conditions that precede major price movements and structural changes in how markets function. Whether this leads to an immediate price explosion or a longer grinding squeeze remains to be seen, but the trajectory seems clear. Physical silver is becoming increasingly scarce and valuable while paper claims continue to multiply. Stay informed, do your own research, and understand that the precious metals markets are complex with powerful players operating with information and resources far beyond what retail investors possess. But the beauty of physical precious metals is that once you hold them, you own them outright, free from counterparty risk and the machinations of the banking system. That's looking more valuable by the day. If you found this information valuable, make sure to like this video, subscribe to the channel, and hit that notification bell so you don't miss our next update on this developing situation. The silver story is far from over, and we'll be here tracking every development. Thanks for watching, and we'll see you in the next one.